Click the bell icon to get latest videos from Ekeeda.
Hello friends, let us understand now the concept of working capital. Capital means the amount which proprietor contributes to his business or arranges from any other sources. Capital can be classified as per different categories based on different parameters. The capital which is required to run day-to-day business is defined as working capital in simple terms. Today we'll understand the concept of working capital in accounting sense, that is particularly management account. Let us understand the concept. Different ways in which working capital has been defined by various authorities. Holland defined working capital as the difference between the book value of current assets and current liabilities. But the term current may mean either a liquid item, example cash, or a circulating item which moves around, that is finished goods stock changes into debtors on sale, which in turn changes into cash on realization. Types of working capital: gross and net working capital, permanent and temporary working capital, balance sheet capital and cash working capital, positive and negative working capital. What is gross and net working capital? Gross working capital means the total current assets without deducting current liability. So gross working capital is equal to nothing but total current assets of the business. Thus gross working capital is equal to the cash balance and the amount blocked in debtors, stock, bills receivable, prepaid expenses, etc. Net working capital: part of gross working capital is financed by the current liabilities such as creditors for goods, bills payable, creditors for expenses. Therefore, net working capital is equal to gross working capital minus current liabilities, or current assets minus current liabilities. Net working capital is equal to current asset minus current liabilities. This is the most common type of working capital and it is also known as net current assets. It indicates the amount available to meet short-term dues of the concern. This concept is useful for calculating the amount of current assets available to meet current liabilities. It indicates the liquidity of the concern in immediate future. Therefore, ratio analysis takes into consideration net working capital only, that is for calculation of current ratio, that is equal to current asset upon current liabilities, to indicate short-term solvency or liquidity. Distinction between gross and net working capital. Gross working capital denotes the amount of current assets circulating in day-to-day operations, while net working capital denotes the amount of net current assets available with the concern. Gross working capital is a quantitative concept, while the net working capital is qualitative concept. Gross working capital indicates the gross current assets without taking into account the amount of current liabilities. The concept of net working capital, on the other hand, compares the amount of current asset with amount of current liabilities to indicate net amount available with the concern. Gross working capital is an absolute figure, while the net working capital is a comparative figure. When current asset increase due to increase in current liabilities, example cash received against overdraft from bank, gross working capital increases but not the net working capital. Management and owners are thus more interested in gross working capital to ascertain the amount of current assets available for day-to-day operation, while creditors and lenders are more interested to know the net working capital, which indicates the margin of safety or liquidity of concern. Permanent and temporary working capital. Permanent working capital, a concern must always have minimum amount of working capital at its disposal to be able to meet current liabilities as and when they arise. In other words, a concern must have minimum amount of funds to ensure liquidity and solvency. A concern must have minimum amount of working capital, that is initial stages to start the business and to commence the operating cycle, and once the operating cycle has started, then to keep the cycle moving in regular course of business. This minimum amount of working capital required to enable the concern to operate at the lowest level of activity. Such minimum amount of working capital is called as permanent working capital. It is also called core working capital. It is the amount of current assets required to meet the firm's long-term minimum needs. Permanent working capital is generally financed by means of permanent sources of finance such as share capital, funds from operations, loans, etc. It is, however, should be not confused with fixed capital. Fixed capital is the amount locked up in fixed assets. Fixed capital is neither liquid nor does it circulate. Temporary working capital. If the concern wants to increase its level of activity and produce and sell more goods, naturally it will need additional amount of working capital. If the increase in level of activity is temporary or seasonal, the additional amount of working capital required is called as temporary working capital. The amount of temporary working capital varies with the level of activity. When the activity is at higher level, larger temporary working capital is needed, and when the level of activity is lower, smaller amount of working capital is needed. So temporary working capital is also referred as variable or fluctuating working capital. Thus, seasonal business like sugar factories require large amount of working capital during peak season and much smaller working capital once the season is over. Temporary working capital can be financed through temporary sources, example short-term loans, deposits, bank overdraft, etc. Balance sheet working capital and cash working capital. Balance sheet working capital. Usually working capital is determined on the basis of balances of current assets and current liabilities as per the closing balance sheet of the concern. Such working capital computed on the basis of on book values of current assets and current liabilities is called balance sheet working capital. Balance sheet working capital shows the amount of net current asset as on last day of accounting year of concern. This concept helps in judging the liquidity and solvency of the concern. Cash working capital. The net current asset include the amount of funds available to concern if and only if all the current assets are realized at book value. However, in reality, the actual cash realized from all current assets appearing in the balance sheet may be less than the book value because debtors include profit margins, depreciation or non-cash charge may have been included as an overhead in valuation of closing stock of finished goods. The concept of cash working capital means making proper adjustment in balance sheet working capital for the above items to arrive at the cash working capital. The cash working capital indicates the working capital at cash cost, debtors at cost, stock at actual cash cost. It eliminates the profit element from debtors and non-cash expenses like depreciation from stock to show the cash cost of working capital. Positive and negative working capital. Positive working capital, when current asset exceed current liabilities, then the net current asset is positive figure and hence it is called as positive working capital. Positive working capital indicates favorable liquidity and solvency position of concern. Negative working capital, when current assets are less than the current liabilities, the net current asset is negative figure and hence it is called as negative working capital. Negative working capital indicates lack of liquidity and adverse solvency position of the concern. Estimating working capital. See, working capital required for the business is required to be financed by various sources. Therefore, it becomes necessary to judge the working capital requirement of a particular business. It depends upon the nature of business, whether it is manufacturing, trading or otherwise. Manufacturing concern units. The following items are taken into consideration at the time of ascertaining the requirement of working capital for manufacturing concerns. Total quantity of units to be produced throughout the year. Total cost incurred on material, wages and overheads. Information about the length of time for which the raw material are to remain in store before they issued for production. That is average stock of raw material lying in godown before actual consumption. The longer the period, the more will be the requirement of working capital. Information about the length of production cycle. The longer the period, the larger will be the requirement of working capital. Information about the length of sales cycle, that is the period during which the finished products will remain in warehouse. The longer the period of stay, the more will be the requirement of working capital. Information about the average credit allowed to debtors. The longer the period allowed to customers, the more will be the requirement of working capital. Information about the average credit allowed by suppliers to the business. The longer the period allowed by creditors, the less will be the requirement of working capital. Information about the lag in payment of wages and overheads. The longer the period, less will be the requirement of working capital. Trading concerns. In case of trading concerns, details regarding units produced, production cycle, raw material, work in progress, etc. are inapplicable. Normally, the details and estimates are given in terms of budgeted amount rather than the units. Steps in estimation. When the level of activity in terms of estimated units, example 50,000 units will be produced during the period, the requirement for working capital is estimated as explained below. The period involved is assumed to be expressed in terms of months in all examples. Estimating current assets. Estimating current asset including estimating each item of current asset like stock, debtors, cash, bank balance at required level of operations. Greater the level of current asset estimated, higher will be the working capital requirement. Let us use different formulas to find out current assets based on the information given in the question, that is amount and period. Stock. Stock will include stock of raw material, work in progress and finished goods. Stock of raw material. How much raw material should be stored by the concern to ensure smooth production has to be estimated. Example, it may be decided to store 2 months production requirement in stock. Value of stock of raw material per month is estimated unit multiplied by cost, that is per month units production multiplied by per unit material cost multiplied by number of months raw material required to be stored. For example, if the concern produces 1000 units per month, cost of raw material per unit is rupees 3 and it decides to keep 2 months raw material stock, then working capital requirement will be for stock of raw material is equal to 1000 units multiplied by rupees 3 multiplied by 2 months, that is multiplied by 2, it comes to rupees 6000. Stock of work in progress. Work in progress includes raw material processed at different stages. Work in progress means the partly finished material which requires further processing. Wages and overheads are incurred to convert the raw material into finished goods. Materials which are not converted into finished goods remain in stock as work in progress. A material introduced in the beginning of the process, and normally it is assumed that wages and overheads accrue evenly during the production process. Therefore, any stock of work in progress is made of 100% of cost of raw material and 50% of cost of wages and overheads. Stock of work in progress is estimated as the total of following amount based on the same formula, that is amount multiplied by duration of operating cycle. Material in process, units multiplied by raw material cost multiplied by number of months required for processing. Labor in process, units multiplied by wages multiplied by number of months required for processing multiplied by half, that is multiplied by 50%. Overheads in process, units multiplied by overheads multiplied by number of months required for processing multiplied by half, that is 50%. Finished goods. Closing stock includes finished goods if they are not sold. The period for which the finished goods remain in store before the sale should be considered while estimating the stock of finished goods. For example, if goods are sold 2 months after the production of goods, then it will be equal to 2 months production. Finished goods stock is valued at cost of production, that is including cost of material, labor and overheads. Profit should not be included as it is not yet realized in cash. If classification of overheads is given, the value of stock should not include selling and distribution and finance overheads. Note that depreciation may be excluded if specifically instructed in the problem set for you, and if the working capital is to be estimated on cash cost basis. Value of finished goods stock is equal to units per month multiplied by cost of production multiplied by number of months finished goods required to be stored. Debtors. Second major component of working capital is debtors. Company's investment in debtors depends upon time lag in payment by debtors. If the period of credit allowed to debtor is longer, the working capital requirement will be higher. If all sales are on cash basis, there will be no debtors. For a company allowing 4 months credit, investment in debtors will be equal to 4 months credit sales. There are two ways of estimating debtors. Debtors may be estimated at cost, cash cost basis, that is the selling price less profit. Debtors may be estimated at selling price, that is including profit. While solving the examination problem, in the absence of specific instruction in the sum, debtors should be valued at sale price. Debtors at cost is equal to units multiplied by cost of sales per unit multiplied by credit period allowed. Debtors at sale price, units multiplied by selling price per unit multiplied by credit period allowed. Prepaid expenses. Some expenses like insurance, sales promotion, etc. would be paid in advance before the due date. We are to estimate which expenses are payable in advance, and to that extent requirement of working capital would be higher. Expenses paid in advance are estimated as follows. Total units multiplied by expense per unit multiplied by period of prepayment, that is advance. Cash and bank balance. Every business concern has to estimate cash and bank balance necessary to meet day-to-day expenses. Higher the requirement of liquid cash, greater will be the amount of working capital and vice versa. Estimating current liabilities. We are required to calculate current liabilities, and those are required to be deducted from current assets to calculate the amount of working capital. So higher the amount of current liabilities, lower will be the working capital requirement and vice versa. We have list of current liabilities, like we have creditors. That is, credit allowed by suppliers on purchase of raw materials gives rise to current liability. That is amount payable to creditors. If we can pay for the purchases later, to the extent we need less funds and lower working capital. A company which makes all purchases in cash will not have creditors, whereas company enjoying the longer credit have large amount of creditors. Creditors for materials are estimated as creditors is equal to units multiplied by purchase price per unit, that is cost per unit, multiplied by credit period obtained. Outstanding expenses. Time lag, that is time gap in payment of expenses like wages, salaries or other overheads gives rise to current liabilities, that is outstanding expenses. A company which pays all expenses immediately in cash will not have outstanding expenses, whereas company which pays rent after say 2 months would have current liability of expenses outstanding equal to 2 months rent. Outstanding expenses are estimated like total units multiplied by expenses per unit multiplied by period of late payment, that is outstanding period. Advance from customers. Some companies take advance from customer before executing their sales orders. These are the funds available with the company are refundable only if sales order is cancelled. Higher advances collected from customers would mean lower need of working capital for the company. Normally the amount would be directly available in question and which are required to be used by the student for solving the question. Provision for contingency or margin of safety. Working capital is basically estimation, therefore it may be sometime more or less than actual. Therefore, to be on conservative approach, we take some amount as what margin amount or provision amount and which we add to net working capital so that we can get exact amount of working capital to be arranged for without any problem of insufficiency or adequacy. Normally, a provision for contingency is made to cover the unforeseen expenses or likely change in the situation. This provision for contingency, also known as margin for safety, should be made as directed in the problem. For example, working capital estimation is 9 lakh. Provision for contingency may be 15% of working capital estimation, which will be 15% of 9 lakh, that is 1,35,000. Working capital estimated 9 lakh, margin of safety added 1,35,000. So total working capital to be arranged for 10,35,000. Rupees 1,35,000 is margin that we have provided for increase in current asset or decrease in current liability as may be mentioned in estimation. In our opinion, such margin should be added only if specifically given in the examination problem. However, some authorities insist on 10% increase in working capital on account of margin of safety. Thus, estimated working capital is equal to stock plus debtors plus prepaid expenses plus cash plus bank balance less creditors minus outstanding expenses minus advance from customers plus margin of safety. While solving the question, first we are required to find out production or output per annum figure depending upon the information of current assets and current liabilities. If that information is mostly in months, we are required to convert per annum output into monthly output. If the most of the information is on weekly basis, we are required to convert yearly output into weekly output. For example, they have given per annum 60,000. To find out monthly output, we have to divide that figure by 12 months. If per annum output is 52,000, we are required to find out weekly basis, we are required to divide by 52. Similarly, we can calculate for per day output taking 360 days or 365 days as per the assumption taken in the examination question. Then format for presentation will be like this: estimation of working capital, current assets, there we have stock. In stock we have stock of raw material, stock of work in progress, and the figures are to be obtained as per our current discussion. Work in progress, material, labor, overheads as per our current discussion. Then stock of finished goods. Second item will be debtors at cost or at selling price given in the examination question. Next, prepaid expenses, cash bank balance. We got now total of 1 plus 2 plus 3 plus 4, that is total current asset. This is also called as gross working capital. Next, we are required to calculate and show current liabilities. Creditors for goods, that we are required to calculate as per our current discussion. Next, outstanding expenses, that is creditors for expenses. Then advance from customers as per the information given in the question. Thereby we'll get total current liabilities, that is point number 1 plus 2 plus 3. Then we can calculate working capital by deducting current liabilities from current asset. To this we are required to add margin of safety. Finally, we arrive at the figure of total estimated working capital to be arranged for. In this video, we have discussed basic concept of working capital, its various elements, types, how to present the statement of net working capital. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.